All right. Just ticked over to 6 o'clock. So why don't we get started? Thank you guys very much for joining. So this is the fourth of our retirement boot camp webinar series. We're going to talk about asset allocation, going into retirement, and then in retirement today. So yeah, thank you for joining. First, we need to go through our little disclaimer. So anything you hear today is general advice. I obviously don't know anything about you. I can't offer personal advice. Questions would be great. So you can send the questions through. I think actually Laura, my colleague, has created a slide. So you can send through questions either in the chat or in the Q&A. I will save all of those for after the webinar is over, based on feedback I got. Also, after the webinar is over, you will see something pop up, and that will enable you to fill out a poll on or a survey on the webinar. So I would appreciate that. Laura, who I mentioned before, who works with me, told me to create a poll on the fly, and I think I've screwed it up, but I'm going to try to launch that. So it's just really around topics for the next webinar. So if you would like to attend a future webinar, we'll probably start them around mid-August, would be my guess. You can reply to the poll if I can figure out how to launch it and if it works. So anyway, there's a poll. It seems to have launched. I also seem to have put it in a third question that was a mistake, and I didn't know how to delete it. So anyway, with the logistics out of the way, or lack thereof, with that poll, we can get started. So yeah, we're going to talk about asset allocation. So we're going to talk about three different things. We're going to talk about the traditional glide path. We are going to talk about an income strategy, and we're going to talk about a bucket method today. So we did get, or I got, a lot of questions around asset allocation. So hopefully this is a topic somebody's interested in, but we will see. All right. So as I said, those are the three different things we're going through. We're going to talk about a glide path. We're going to talk about a bucket approach. We're going to talk about a dividend-based approach. And if we remember some of the topics that we went through previously, obviously we spent some time in the first two webinars talking about how to come up with, estimate how much you need for retirement, come up with a personalized withdrawal rate based on your own circumstances. And then we talked about some of the risks that we're facing. So very quickly, there are two main risks that people face: longevity risk and sequencing risk. So quick reminder, longevity risk is, of course, we don't know when retirement will end because we don't know when we will die, which is, of course, a problem in terms of coming up with a plan so that you don't run out of money. So longevity risk is simply running out of money before you die, which is a problem. Then we have sequencing risk. So remember, sequencing risk is the fact that what matters over your retirement is not the average return that you get, although that is important, but it also really matters what order those returns occur in. And so, of course, if you have the misfortune of retiring into poor market conditions where the market drops significantly while you're pulling money out of your portfolio, that is an issue. Because, of course, when markets recover, depending upon how long that takes, you will have less in your portfolio to benefit from those recoveries. So that is a situation that could cause a retiree to, once again, run out of money, which we do not want. Now, the problem, and we'll talk about this with the glide path, the problem is that the traditional approach for dealing with both of these risks is actually opposite from each other. So if we are worried about our portfolio dropping a lot early in retirement, what should we do? Well, we want to remove volatility from that portfolio. So we want to invest more in defensive assets, so bonds and cash, for example. And that means that your portfolio will be less volatile. If the market does go down significantly, your portfolio will fall less. The problem is that, of course, for longevity risk, what we need is higher returns. You have higher returns. Of course, if you live longer, you will be drawing on your portfolio longer. And so we need higher returns to replenish that portfolio. What do we do to get higher returns? Well, we invest in more growth assets like shares. So you can see the problem here, that when we're dealing with both of these risks, the solutions to them are the exact opposite. And that is the issue that we're trying to deal with today. And that's the issue that we're dealing with asset allocation. Now, we spend a lot of time in talking about investing, talking about specific securities. What ETF or share should I buy? But the biggest driver of returns is asset allocation. So allocating more to growth assets over the long term. And remember, retirement is the long term. Many people can stay retired for potentially as long as they've been working. So over the long term, that asset allocation really matters. More growth assets, there's higher expected returns. More defensive assets, there are lower expected returns. So we're going to talk a lot about asset allocation and try to use it to solve these two problems. So let's start with the glide path approach to asset allocation. Now, I took some information from Vanguard. The reason I did that is Vanguard has a super product called Vanguard's Lifestyle Super Option that is essentially a target date fund. You might have heard that terminology. So what that does is everyone invests in this life cycle super option, and automatically over time, it will reduce your allocation to growth assets and increase your allocation to defensive assets. So really what they're trying to solve here is they're trying to solve that sequencing risk. And target date funds like this Vanguard Life Cycle Super Option are very popular in the US. They're very popular in 401k plans. They're not as popular in Australia, but you're starting to see them more. In Vanguard, obviously, with all of the efforts they put into launching a super product in Australia, is obviously leading the charge on this. But other providers provide them as well. So very simply, as I described, this lady walking wherever she's going, I guess towards retirement, you can see that as she ages, it is reducing the amount allocated to growth assets and increasing the amount into defensive assets. A pretty simple concept. And this is regardless of the fact that this life cycle option automatically does this is the advice that you get from many people. As you get older, you just simply put more money into defensive assets. So whether this is happening automatically or whether it's happening through your own decisions, whether that's switching a pre-mixed option in an industry super fund, whether in your self-managed super fund, you are simply buying more defensive assets, selling off some of those growth assets. That's the advice that we typically get. So how does this work? Now, I'll just demonstrate this very quickly. So Vanguard on their website allows you to go in and put in your age. And you can see, all right, as a 35-year-old, which I wish I still was, you can see the objective. Their objective is 3.75% above CPI. So that is inflation. Those are those returns on top of inflation. And you can see the investment mix. They're saying at 35, you will have, and remember, this is automatic. At 35, you'll have 90% growth assets, 10% defensive assets. So that's great. You get older, now you're 55. Well, all of a sudden this starts to change. You see that return objective comes down. You see now you've got 72% in growth, 28% in defensive. Finally, 65, maybe you're considering retirement. Once again, the return objective comes down. The investment mix changes, 50%, just under 50% growth, 50% defensive. So that is you on this glide path. Whether you like it or not, this is what's happening automatically for you. So what are the potential benefits and issues of this? Whether you're doing it yourself or whether you're in a product that will automatically do it for you. Well, this obviously is not customized for you. The only input that they have is your age. They don't know how much you need for super. And remember, as we're trying to, and the whole point of the first two webinars, where we're trying to come up with the estimate of how much we need for retirement, is then you can make decisions on how to actually do that, or how to actually achieve that goal. So that could be saving, changing your savings rate. It could be focusing on asset allocation, knowing that over the long term, wherever you are approaching retirement, over the long term, that those growth assets will have higher returns. It's making sure your asset allocation is appropriate and your savings are appropriate to try to get you to that target. Now, this doesn't do any of that. So whether you are way behind in super or way ahead in super compared to what you're trying to get to, you are just going to march down this glide path with more defensive assets as you age. So this isn't personalized at all. And while that may work for a lot of people, the fact that you've decided to spend Tuesday evening going to a retirement webinar probably means that you're putting some more thought into retirement than most people. So a glide path approach is unlikely to maximize returns over the long term, right? So maximizing returns is not always what we want to do. There's a lot of reasons why we don't want to do that, but we just have to understand that as you increase with more defensive assets that have lower expected returns, that your returns are potentially going to be lower than what they could have. What it is doing very effectively is protecting you from sequencing risk. So if we go back onto this slide, let's say you retire at 65, the market tanks, the share market falls a lot, you retire into, and we'll go through some examples of this later, what we mean by retiring into a really terrible situation. You retire into the dot-com bust, you retire into the GFC, you have that misfortune around the time of your retirement. Well, this is going to protect you, right? The fact that you have 50% of your assets defensively. So it does do a very good job of that. The concern, of course, is with that longevity risk. So if you're getting too defensive too early, then all of a sudden you might have this problem if you happen to live a very long time. So one thing to think about is that, of course, when you are working, everyone, of course, talks about retirement as this magical date. And maybe it is for the other parts of your life. But the day you retire, you are going to wake up the next morning and still have most of your money invested. You're still going to have to earn returns. And as I said, you could still live for a very long time, and you could live for a period of time that is longer than you actually worked for. So while it is a destination in many ways from an investment standpoint, you're investing right through that date that you actually retire. So I wanted to go through and spend more time tonight talking about two different approaches that potentially you could take. And we're trying to go with this concept of treating the disease and not the symptoms. So the problem with sequencing risk is not actually volatility. If you experience that same volatility when you were 45 years old, as long as you didn't panic, it wouldn't really have any impact. We know that we are going to face recessions and market drops. It's just inevitable over a lifetime of investing. If you are retired for a significant amount of time, you are going to face those in retirement as well. So we know that's going to happen. But the problem is not actually volatility with sequencing risk. The problem is selling after the market has dropped. So the advice that we give to people who are not retired is don't sell. Don't sell, hang in there, wait for a market recovery, which has happened every single time we've seen one of these drops. The issue is, of course, as a retiree, you need to pay for your life. So you have to sell. And that is the real issue with sequencing risk. It is selling when the market has dropped significantly. It is selling low. The advice that everyone gets, don't sell low. Well, you are forced to do that. That is the problem, pulling money out. And then even if the market recovers, as I said, you have less money to actually take part, you have less assets in your portfolio to take part in that recovery. So that is the problem we're actually dealing with. So I'm going to go through two solutions. And the solutions are going to try to prevent that real problem, that problem of selling. Now, to do this effectively, and we have to be honest about this and how hard it is, two different things need to happen. The first thing that needs to happen is you can't panic when the market drops. And everyone that I talk to about panicking when the market drops, mostly, I guess, young people who haven't been through one of these drops, and no, COVID did not count. That was very, very short. And I think we're all panicking about everything else. most people sit there and say, of course they won't panic. They understand this. They understand everything I just said. You don't sell when things are low. You don't sell after market drops. You hang in there. But it's actually very hard to do in practice because, of course, what are you doing? Well, you were ultimately panicking. You are sitting there watching your portfolio drop. That is very disconcerting. It's very disconcerting in retirement. If you don't have a job, there isn't money going back into that portfolio. So just have to be aware that you can't do that. And I think it's really where some self-awareness comes in. What are some ways that, or how would you react during this? If you are approaching retirement, you've been through a lot of these periods, how did you react? What were the feelings that came up? Really know yourself and think about what you're doing. And that's really important. Then, of course, you need to hold on until there's a recovery. So I put this Keynes quote in: the market can remain irrational longer than you can remain solvent. So not only mentally do you have to be able to hold on, you actually have to have enough to put food on the table and pay for your expenses in retirement. So those are the two challenges that both of these two suggested approaches will put on you if there is a market drop. All right, so let's talk about market drops. So since World War II, these are the 5 biggest market drops that have happened. So extra points, if anyone really remembers this 1946 one, you may have been alive, probably weren't paying attention to the stock market, but you can see the average decline was over 40%. But what really matters, of course, are this decline. These are big numbers. So imagine your portfolio, especially if you're newly retired, you don't have any income coming in, you're not saving anymore. Imagine the impact if your portfolio is dropping significantly in these ranges. So that's the first thing you have to consider. The next thing you have to consider is how long. So that Keynes quote about remaining solvent. So typically when people talk about bear markets, they will talk about that peak to trough, right? So that is the fall in the market from whatever high it was to whatever low it is. And people use that, talk about how long a bear market is, but that's not what you're trying to deal with. You also need the market to recover. Now, it doesn't have to recover to exactly the same level. That is important to say, but really what we need to add up is how long it took for the market to fall and how long it took to get back to break even. And you can see these are, in some cases, significant amounts of time. Particularly, I mentioned the dot-com crash. So almost 80 months. So that is a long time. That is the period of time that you need to remain solvent, an average of 55 months, right? So these two big, long bear markets that we experienced in that first decade of the 2000s, those were long bear markets and recoveries. So something really important to remember. And even if you look at this dot-com crash, that it took over 2 years to actually even get down to that trough, and then a very long recovery. So that's what we're dealing with here. And the reason that we plan for retirement is if these worst case situations happen. You quit work on the 24th of March, 2000, well, you were in for a wild ride. And that's that sequencing risk. Those are the real concerns that we have. All right, we're going to talk about the first method is, so I did see somebody mention the 87 crash. There were more crashes. There were more bear markets since World War II. I just picked the 5 longest. So just remember, there were more bear markets. But what we're trying to do with both of these approaches is we are trying to make sure that we can survive something really bad that happens. Future's unknowable, but I do think we need to look back at some of the worst ones in the past, in the recent past, when we're considering if we want to take one of these approaches. All right. So the first one, the bucket approach to asset allocation. So very simply, and there are resources, that resource page will pop up at the end that do have more information on this. But very simply, we bucket our assets into, or we group our assets into buckets. Now, traditionally, people talk about this 3-bucket method. It's kind of simple. One bucket has cash. One bucket has less volatile investments. So we speak a lot at a high level between bonds and shares, but not all bonds are the same. Not all shares are the same. So typically you get less volatility with shorter term bonds. So if you go out there and buy a 1-year bond, a 2-year bond, you're going to have less volatility than if you're buying a 30-year bond. So bonds have different levels of volatility. Shares have different levels of volatility. So bigger companies in good financial shape who typically pay high dividends are less volatile. You generally get less upside, but you're not going to bounce around as much as if you're investing in emerging market small cap. So small companies trading in emerging markets. So we have to just remember that we can group those assets. So bucket 1, cash. Bucket 2, defensive assets. So that can be defensive assets, lower volatility growth assets. Bucket 3, growth assets. And we'll talk about asset allocation in these buckets in a second. But really, the purpose is during normal market conditions. So normal market conditions are not bear markets. They do happen over time, but normal market condition, I'd say right now we're in a normal market condition. Market's going to go up, the market's going to go down, but no dramatic swings. So what do? Well, in bucket 1, cash gets pulled out. So if it's in super, you're pulling that super out, that cash out. You are spending that on whatever you want to spend it to. Bucket 2, you are selling those assets and you're replenishing bucket 1. So there's no reason not to sell those assets because markets are normal. We are not selling low. We are just going through and trimming off our portfolio to pay for our life. Bucket 3, we're selling those assets and moving them into bucket 2. So pretty simple. Just moving money down to these buckets, basically keeping a constant, and we'll show the percentages that have been suggested by a colleague of mine on the next slide, basically keeping that constant percentage in. Money comes out, money moves, and so you're keeping that, just like any rebalancing, you're keeping that overall portfolio in the same percentages that you have as a target. But then what happens in a down market? So that's the market going down. It's not depressed. You might be depressed if it's going down. But what do we have there? Well, we're spending our cash bucket. What we're trying to do is hold on to what is in bucket 2, definitely. And in bucket 3, those growth assets where you are having even greater drops in prices, you are not selling. You're waiting for the recovery. And bucket 1 and bucket 2 are supposed to protect you during that. And bucket 2, you might selectively sell. You've got some bonds in there. You've got some shares. If shares are plunging, maybe you hold on to those, sell the bonds, which hopefully are less volatile, sell those less volatile bonds, the ones that are shorter term. And you're just replenishing these buckets again. The allocation between these buckets is based on, of course, how much risk you want to take as an investor. Now, conceptually, I'll say that, this strategy is the same, whether you use 3 buckets or 2 buckets. I will talk a little bit about the approach that I've taken with my mother, which is a 2-bucket strategy, basically cash, more cash, and cash. And then the other bucket is lower volatility growth assets, so large dividend paying companies. That's another approach you can take. But anyway, the idea is to kind of segment out these different assets that you have to try to not sell when the market drops. Now, the allocation from these different buckets. So a colleague of mine, I act like I talk to her every day. She's in the US. Her name's Christine Benz, and does a lot of work around bucket strategy. So these are the different allocations that she suggested in conservative, moderate, and growth. And you can see the allocations to the different buckets. Now, what I would say is really, and sort of the way that I've thought about my mother's portfolio is really what matters in this first bucket. Yeah, it's great to say 12% cash, but really what you're thinking is, okay, how many years can I go without selling other assets? So what do we have here? Let's say you're pulling out 4% of your portfolio. Well, so this could last you 3 years. You're probably going to raise the amount that you bring that you pull out a little bit based on inflation. So 3 years, 2 years for this growth. It's really just thinking about how much safety you want in here. So because I'm using a 2-bucket strategy with my mother, and she's been retired for a long time. I think she's probably on here because she's crazy, wakes up at 3 a.m. in Nashville to watch these things. But I took a more conservative approach. I put 5 years worth of living expenses when she first retired into cash because I personally am not a giant fan of bonds. So I wanted the rest of her assets were in dividend paying large companies that generally are less volatile to replenish that bucket with the dividends no matter what happens. So I went a little more aggressive in cash and then a little more aggressive in growth assets. But it's really thinking that through and thinking about those different scenarios and what you're comfortable with. All right, so what are some problems with the bucket strategy? So a couple of problems are, number one, this can be challenging to put into place based on the super fund you're in. Okay, if you are in a pre-mixed option, you basically can't really do this without switching around the options that you're in. Because if you're in a pure pre-mixed option, when you say sell and you want to pull something out, they're going to sell a little bit of everything, right? Every single asset class that they have in, they'll sell a little bit of that to fund that withdrawal. So it makes it harder. But you can say, you can, of course, have other options, even if you're in an industry super fund, where you are actually going in and making decisions about what's sold, and you can have all sorts of spectrum of control over those different assets. This is obviously a lot easier to do in a self-managed super fund. The potential problem, of course, that also complicates this and complicates the dividend approach I'll talk about is those required ATO withdrawals, of course. That can make it more challenging, even if you're not planning on spending the money. It can make it more challenging if you're older and all of a sudden you're depleting that cash bucket really fast because the ATO is making you take money out of your super. So there are some challenges, but remember, you can hold assets outside of super. So even if you're pulling them out, you can keep it in cash, you can invest it. Obviously, there's some tax consequences, but it can be done. Those are challenges. Okay, let's move on to the dividend approach to funding retirement withdrawals. And you can use both of these strategies in conjunction. And a question that I got a while ago, which was a very good question, I was doing a webinar on, I think it was a webinar or it was an email that came to me, but I was talking about the 4% rule. And the person asked, which is a great question, and said, well, the ASX 300 is yielding over 4%, and I get franking credits. So why would I even worry about withdrawals? I can just generate that amount of cash in dividends and then just pull it out and pay for my life. And that is true. Now, I'll talk about some of the risks involved in this, but basically a dividend approach to funding retirement withdrawals is having enough money to support yourself off of just income generated from your portfolio. Now, a couple of things to think about here. Number one, it's a great position to be in if you can get yourself there. You have to be able to get yourself there. Typically, if you have a globally diversified portfolio, despite what the ASX is yielding, we'll talk about some pitfalls about local shares, despite what it's yielding, that's a lot more challenging to do in with a globally diversified portfolio because dividend yields are so much higher here. With a portfolio that's diversified into bonds, have some cash, it can be challenging to do depending upon the interest rate environment. We're getting pretty good interest rates right now. But if we go back to, a couple of years ago, of course, we were getting nothing on cash and nothing on bonds. That also makes it very challenging. So just some things to think about. So the two considerations that you need to think about is that not only do we want to support, let's say, a 4% withdrawal rate, we also need to account for inflation. If you want to maintain a real standard of living, and we talked earlier about how it's important to have a personalized inflation rate, think about the things that you're paying for. You own your house outright. You don't really care if mortgages cost more, if rent costs more, because it doesn't impact you. If you're traveling a lot, travel's gone up a lot, everything's gone up a lot. So you have to think about the different drivers of your finances. But either way, you're going to want to adjust the amount that you take out of your portfolio as time goes on. So in order to do that, using an income strategy, you need to grow your income. That's why we can't just go and find all the high yielding shares. We need to focus on dividend sustainability. We need to focus on dividend growth. And that's some of the challenges around investing in Australia, is that while we get higher yields, historically, and we'll look at a couple slides after this, historically, there has been less growth in Australia in dividends than the US, for example, that is much lower yields, but more growth. And there's all sorts of reasons, and I could do an entire webinar on this. But the other thing that we have to consider, of course, is where dividends come from. And it is a fortunate situation, I guess, in Australia, if you look at overall yields, that some of the largest companies pay healthy dividends. I wrote an article looking at some of these large companies and what our analysts thought about dividends going forward, and it wasn't a pretty picture. So basically looking at the banks, looking at the large miners. So yeah, just something to consider. And that's that challenge of balancing high yield and income growth, which makes it harder to meet your spending needs unless you have a lot of money or spending very little, and probably a combination of both. We run into the same ATO challenge again. Remember, the reason that we're doing this is because we don't want to sell assets if the market drops significantly. Now, fortunately, because even with those escalating ATO rates, it is based on the amount you have in your portfolio. So if your portfolio is dropping a lot, that percentage rate, of course, will mean less money is coming out. But something to think about. How can we also do this with dividends fluctuating? Well, we can use a cash bucket, right? This is certainly not saying invest your entire portfolio in dividend paying shares. Hold a cash bucket. It can protect you against times when dividends are falling. So we're going to go through two charts. I got these charts from Standard & Poor's. I think they're interesting. A couple of years out of date, but what this first chart is looking at, and this is, remember, we have to worry about those fluctuations in dividends if we are trying to live off of those dividends. This looks at the ASX 300 largest shares in Australia. So a couple of things that we can look at, and really the most important one, I guess, is this size of dividend pool. So these are the total dollars that are getting paid in dividends. And if we go year by year, we can see that there are fluctuations, right? We can see a pretty big drop between 2015 and 2016. You can see a little bit of a drop in 2018 to 2019. So dividends are going to change and not always go up. We obviously see this huge drop during COVID, which of course makes sense. Companies were trying to conserve money when the economy was shut down, so they weren't paying it out to shareholders. So just have to be prepared. And this is why we're talking about that cash bucket, to wait for recoveries. We have to be prepared that there are going to be times where dividends go down. The other thing, of course, is this yield. You can see the yield has fluctuated. So yield, of course, dividends are important. Prices of markets are important as well. But we can take a little bit of a little bit of a look of what could support at different times, and it won't matter, right? If you're invested earlier, what matters is that it matters when you retire, and that yield when you retire. It could change over time, but the dollar figures would fluctuate based on this column. So we can see, hey, this would have been really challenging to retire in 2020, right? That yield is a lot lower than what could be, than what most people would want to spend. And remember, franking credits are on top of these. None of these have included franking credits. The other thing we have to look at, this is, of course, somebody who's invested in the ASX 300, all right? And the weightings in that are, of course, based on market capitalization, how big those companies are. But if you have a portfolio full of individual shares, well, it's great what the overall market does, but you're really concerned about what you actually own. And so we can see three different things. This chart is also from S&P, Standard & Poor's. We can see the number of companies, and these are all the dividend payers, out of all the dividend payers in the ASX 300 that pay dividends. That's not everyone, but since we're in Australia and everyone loves dividends, it's a lot of the companies. We can see the number of companies that raise dividends. If you are in, I'm not real good with colors. Like, I know what colors are. I'm just colorblind. So I'm just going to point this big line. You can see that the number of companies that raise dividends, if you own those, great. We can see the number that maintain dividends, and we can see the cuts. So, of course, we can see what happened in 2020, that a lot more companies, almost half of the ASX 300, cut their dividends. So no matter what is happening, if you own a lot of these that where dividends have been cut, that could be a problem with this strategy as well. But you can see in both of these, if we are looking at either that bucket portfolio, a dividend portfolio that combines with potentially a bucket portfolio, you can see really what we're trying to do is we're trying to protect ourselves from having to sell when we don't want to. That doesn't mean you're not going to sell. You, of course, are going to sell over time. You don't want to be the richest person in the graveyard. I don't know, maybe you really love your kids and want them to have all the money. You are going to sell, but you're just going to sell at times that you want to. So what we're trying to do is we're trying to protect ourselves from sequencing risk by not selling when we don't want to. We're trying to keep enough assets in growth assets so we can deal with living to 120. Those are the two things we're trying to deal with. And so both of these, and while both of these do, of course, involve risks that we can think of ways to mitigate them, but both of these involve risks. We're trying to deal with those two issues without doing that traditional glide path. And I think the reason, and there's nothing wrong with the traditional glide path, but the traditional glide path is really challenging if you don't have enough money for retirement. It's really challenging if you live a very long time and your portfolio gets too conservative. And, you know, I won't speak for everyone on here. Most of the people, maybe these are just the people that talk to me. Most of the people I talk to, even in retirement, have a significantly higher allocation to shares than we saw on that Vanguard graph. Now, whether that's right or wrong, I think given how markets have performed since the GFC, it's probably worked out pretty well for most people, but those are based on market conditions, right? What we worry about is if we are retiring into this dot-com crash, this crash during the 70s, the GFC, if we're retiring right into those really long scenarios of a bear market, it could be a problem. And remember, the whole point of planning for retirement is to try to deal with the bad luck of that happening. And that's really where we're going with those two approaches. All right, so there's some questions. I'll go through the questions, but yeah, ask away. I'll start with the Q&A because I think I did potentially miss some of those last time. All right, so is a glide path approach preferred in the U.S. versus a bucketing approach? Listen, I wouldn't say that it is preferred. Um, I think there's a couple issues with the U.S. So there's a lot of issues with the U.S. I'll just deal with the investing ones. It is very challenging to take that dividend approach in the U.S. So right now, the S&P 500 is yielding about 1%, I believe. So it becomes very, very challenging for a retiree to even consider that dividend approach. So that's kind of thrown out the window at the end of the day. So because of that, and I think because I would say that there's probably more financial innovation around retail products. US is obviously a bigger country, but there are thousands of ETFs, way more than are needed, by the way. There are thousands of ETFs in the US. There's something like 6 times more ETFs in the US. There is just more financial innovation. And I think one of the areas of financial innovation has been this glide path. There's been a big debate around these sort of target date automatic changes in asset allocation. So there's been a big debate in the industry there. But yeah, I'd say it's just offered more than in Australia. The U.S. is also, people invest much more. They invest passively more than they do in Australia. If we look at kind of the percentage of investors or percentage of assets that are invested passively, and this glide path approach can work with active or passive, but works very well for passive. So you can have a couple passive investments in those and automatically rebalance. So we've got a question: can you give some ETF examples for each of the buckets? I mean, I can certainly give examples. I'd say these are not recommendations, of course, but if you start thinking about some of the ETFs that would be in that growth bucket, so Vanguard Australian Shares is certainly one. We talked about the ASX 300 a lot. That's something that is rated highly by our analysts. That is in that equity bucket. So. The iShares product in the S&P 500 for investing globally, IVV. So those are just examples of just passive investments that would be in those buckets. There are plenty of bond ETFs. Tickers are escaping me because bonds are boring and I haven't memorized them all. Doesn't mean you shouldn't have them in your portfolio. But yeah, I can, if you send me an email, Jan, I can send you some articles where we've written about different ETFs that Morningstar likes that would fit into those different buckets. All right, so John has a question: why are you so opposed to bonds? Are you referring to just government bonds or corporate bonds as well? Yeah, John, how long do you have? So I think my concern with bonds is, at the end of the day, what are you trying to do with a bond? Well, you're trying to lower volatility in a portfolio, and you're accepting lower returns for that. And I think my problem is, to me, the trade-off between a bond and cash isn't huge. And this is obviously a personal opinion. Doesn't mean you should follow that. And I don't think that the volatility. I think people think that bonds are, and you can do this, that you can go out there and just buy a bond and you wait for it to mature and you've locked in this interest rate and that's great. But most people access bonds through funds and ETFs, and there is a lot more volatility than I think most people think. So those ETFs, for example, invest in a basket of bonds, one that lowers your yield, because in a rising interest rate environment, you still own bonds for when interest rates were low. They're constantly replenishing that portfolio. It also means that it is more volatile than most people consider when just buying a bond, because there is no maturity. Some bonds will mature, but new money will go into the ETF. They'll have to constantly buy new bonds. So I just don't think that the trade-off between what you get with bonds and what you get with cash is that different. And if you go back and look over the long term, the difference isn't that much. And I don't think it's worth exchanging something with no volatility, which is cash, for something that has actually a fair amount of volatility, depending upon what kind of bond funds you're in or bond ETFs you're in, I just don't think the trade-off is worth it. That's a personal opinion. Most people disagree, but I am comfortable with cash and shares, particularly the types of shares that I typically gravitate towards. As I said, larger companies, less volatile, high dividends. So yeah, it's kind of more of a personal opinion than anything else. So that's certainly not advice for anybody, but I have written an article, I think creatively titled "Why I Don't Invest in Bonds." If you email me, I can send you a copy of that kind of explains that in a little more coherent manner than me rambling on here. All right, so let's go into the Q&A, or go into the chat. You guys are all chatting a lot. Let's see. Oh, somebody has an AI assistant helping them take notes. I do not know how to do that. So under the bucket approach, you're giving up returns in cash compared with shares over time. Why? Well, you're doing that for protection, right? And the slide that I actually have on the screen, you're doing it to protect yourself from those situations. So cash, as I said, has no volatility. Does it have lower returns than shares? Absolutely. If you want to get the highest return and not sell anything for, if we look historically for the last 100 years, you'd put everything in shares. But in the real world, we need to sell things. Life happens. We need to sell our shares to pay for our life and retirement. And that cash is protecting you. So, well, I think some people could sit there and look at that cash and think, oh, it's such a drag on returns. I see it as an enabler of having more money invested in growth assets because it's providing that protection. And we can kind of say this about everything, right? Like, why do you have insurance on your house? It's probably not going to burn down, which means you spent your entire life wasting money paying the insurance company. But if it does burn down, it's nice to have that insurance, right? So it's kind of the same concept. That's really that insurance, and it's protecting you so that you can take risks with other parts of your portfolio and hopefully get higher returns. So we had this super question. I think I answered that. Okay, so we've got a good question. Which bucket is the investment property in? All right, so we can't get through, obviously, a webinar without talking about investment property. So I guess, Sam, what I would ask yourself is, what is the purpose of your investment property? And purpose in terms of, is this a situation if the investment property is negatively geared? Well, at least for right now, you're not getting any cash flow out of that. So in that case, your plan is probably for the investment property to appreciate and sell it at some point. So I think kind of where it goes in terms of, and this probably, my guess would be, since it's a property, is probably a large part of your asset allocation. So if you're going to plan to sell it at some point during retirement, I guess I think about, when are you going to sell that? When are you going to convert that investment property into cash that you can use to pay for your life? Or is this something that is potentially something you want to pass on to your heirs? So I think first, like, what is the plan to convert that investment property into cash? If the property is positively geared and you are getting cash flow out of it, well, I mean, then ultimately it's like any other income generating portion of your portfolio. If you have that investment property sitting in super, that can fund that cash bucket. That can replenish that cash bucket. Obviously, properties can go down in value, even if they haven't in a very long time, in Australia, at least over a long stretch. But if it's generating healthy cash flow, we'll just keep replenishing that cash bucket with it. And think about, hey, is there an opportunity? Is there a time that you want to sell that? So that's what I would think about. Okay. What do we have? I think you guys are doing a good job at answering questions. I keep saying that somebody else should do this. So we've got a fan of Nashville. I like Nashville as well. Have you set up bucket approach in industry super fun? Use only 2 buckets. Oh, have just set up. Use only 2 buckets. Rejecting the idea of bonds is bucket 2. All right. Yeah, I mean, I agree with that. Seems like most people are just talking to themselves. That's nicer. Cleaning the office now. Okay, so Anita says, I'm guessing the 4% withdrawal rule is applicable to pension phase. So there's always the option to leave money in accumulation phase when you don't need to withdraw at all. Listen, the 4% rule ultimately, well, first of all, between pension phase and accumulation phase, the only reason you would logically leave money in accumulation phase is if you can't put it in pension phase because you're exceeding that $1.9 million cap. Because remember, if it's in pension, you're not paying any taxes. So if you are looking at your portfolio holistically, you've got $3 million, you can't move it all into an account-based pension, you should still look at your portfolio holistically in terms of that withdrawal rate. So even though you're only taking it out of that account-based pension, you want to look at it all when you're setting that withdrawal rate, unless there's some reason you want to exclude money from your own retirement. And basically that reason is that you want to pass it on to someone or something like an organization. And then maybe you would want to sit there and say, okay, it's really important to me to leave X amount of dollars to someone or something. So I'm just not going to consider that part of my money. And then you'd set that out of just a segment of it. Let's see. Sorry, there's lots of comments. Mostly you guys talking to each other. Which once again is great. Sorry, just reading through these. Yep, I agree with Howard. Yeah, Australia is very different in terms of the dividend yield you're getting. So that's why it's hard to compare. So David says glide path should not have automated changes as they may mean changing out growth assets, equities in a down market. Yeah, I mean, whether they should or they shouldn't, they do. And it's really interesting. Like if we think about basically what you're saying is when COVID happened. So what did the government come out and say to retirees? Well, they actually changed the required minimum withdrawals. They lowered them for retirees. And why? They're trying to protect people from being forced to sell assets in a low market. Obviously, it recovered pretty quickly. So we've got a question about, will you hold a session on guaranteed life income insurance products that are linked to domestic? Yeah, I mean, maybe. I'd have to study them a little bit, but yeah, that's a good question. All right, your thoughts on using an annuity as part of the defensive bucket while also shifting some risk to the provider. Okay, so surprisingly, I'm not retired yet, even though I'm aging rapidly by the second. I think annuities are pretty good strategies. The way that I would think about an annuity, if you wanted to use a partial annuity. So one thing you can do, of course, is you can put your entire portfolio into annuity, or you can select different parts of it. And really, we talked about flexible withdrawal rates. We talked about dividing up between wants and needs, right? That what do you need? Well, you need somewhere to live and you need to feed yourself. And then there can be this whole category of wants. So I'd maybe think about your expenses. If you do want to take some risk off the table, potentially an annuity that covers your needs, your portfolio covers your wants, with the thought that if there are horrible market conditions, you could cut back on the spending on your wants. So that's something that I think is kind of attractive. It's something that I think I would consider when I get to retirement. So yeah, I think that's something you can do. You can obviously have that annuity feeding into that cash bucket, and that can just be another. We can think of it as an income generating asset that's putting money into that cash bucket. So yeah, I think that's a great approach. Do hybrid ETFs fit into the middle bucket? Question by Darrow. Yeah. So I think certainly they would fit into that middle bucket. Now remember, hybrid is, well, obviously is equity like, not obviously, it is equity like and has bond like characteristics. But you're protected from some of the risks from bonds because they're generally floating rate. Most of the institutions that issue hybrids, I would say, are relatively safe. So yeah, I would put that into that second bucket. Here's an easy one to answer. Are you going to post a recording of your webinar somewhere, please? Yes. So they're all on a article page. As soon as this thing ends, a link will pop up. You click on that, you can see last week's and the previous 2 weeks' recordings. Yeah, all the resources and the presentation. So the presentation for anyone watching, presentation from today is on that link. It's already on there, plus some resources. So you can just go onto that page. Okay, so Andy says, what rate of return would you have in each bucket, or do you only look at volatility? No, I mean, listen, obviously the rate of return, we don't know what's going to happen in the future. But if we look historically at rates of return, we can get an idea of where we think potentially over a longer retirement you could have. So, you would have highest returns in that third bucket, which has your growth assets in there. If you look at, I think kind of conservatively after fees, after potentially taxes, which may or may not be an issue in retirement. I mean, I think certainly a 7-8% return is probably realistic, hopefully higher. If we start looking in that middle bucket, based on interest rates, based on how much of that is allocated into more growth shares, I mean, I think you could probably get a 5% return. And then we can look at that cash bucket is very dependent on interest rates, right? Because as they change, the banks automatically, you can have term deposits and things like that, but the bank's obviously going to zap you right there. We have James, the marketing bot. I don't know, maybe that's that AI assistant that we talked about. Okay, so he says, I've calculated my portfolio 11% cash, 77% defensive. I think you mean growth, and 10% defensive. Should I take action to 10% growth? I mean, listen, it's certainly I certainly obviously can't offer advice. I don't know how old you are. I don't know what you're trying to accomplish. What I would do is I'd sit there and I would think about what you're trying to achieve with your portfolio, what withdrawals you're trying to achieve. I don't know if you're in retirement or not in retirement. So I think all of those are considerations. So it is difficult to answer. So I just won't, and I can't give personal advice. Question, if I have an investment property, would relying on rental income from the investment property to fund my retirement be a good idea? Is it more reliable and stable than dividends? Chance of rental income go down is lower. So, what I would say, without knowing obviously what will happen with rental properties in Australia in general, and obviously not knowing what's going to happen with markets, the problem is that unless you have a large portfolio of rental properties, you're very dependent on one place. So there's not a lot of diversification. You're dependent upon whatever location your rental property is. So prices could go up all over Sydney, but not in that one specific location. Prices go up all over Australia, not in that specific location. There can be issues, obviously, with investment properties around maintenance, around tenants. All sorts of things can happen. So the only thing I would say is a well-diversified portfolio may not, and depends what the yield is on the investment property, well-diversified portfolio may not match that yield that you're getting, but it's probably safer because that very property-specific issue could derail you. So that's the only thing I'd say about an investment property compared to a dividend portfolio. All right. Let's see. Oh, we have a couple more questions. Going back and forth between the Q&A and the other one. Is there any article you can post on low volatility and high dividend assets? I can't post it right now, but if you send me an email, mark.lamonica1@morningstar.com, it should be on all the invites. I can send you some information to look at that. Just remember that when I am saying that generally large dividend paying companies have less volatility, I'm talking about with the share market in general. So they'll still be more volatile than cash, than bonds. But I wrote an article, Why I'm an Income Investor, that goes through and looks at a study of volatility and returns from different types of dividend paying shares that might be helpful. Do you consider annuity products a safer alternative to cash and fixed term deposits? And where do annuities fit into the asset class? Listen, an annuity is a bond at the end of the day, right? Just like the age pension is a bond in every other sense, right? It is a set amount of cash flows that are guaranteed. That's a bond. Now, obviously, the bondholder can default. There is that default risk, but they're basically guaranteed. You go out and buy a safe bond, an Australian government bond. Well, if Australia can't pay back the bonds, you're probably not getting your age pension, right? It's kind of the exact same thing. So yeah, I would consider an annuity as just fixed interest. So that's kind of where I bucket it. Private credit. Okay, a question about private credit. Shani and I actually recorded a podcast today on private credit, which I think comes out this weekend. Private credit, they're bonds at the end of the day. Now, I think there's some very specific risks to private credit that probably aren't talked about a lot, but they're bonds. Private credit are more, when I talked about that spectrum of bonds, private credit are basically high yield bonds. So you're going to get a higher interest rate. There's higher default risk, in my opinion, even if we haven't historically seen it. They're lending to the same companies as high yield bonds, basically. So yeah, it's within that defensive asset bucket, but further out in terms of risk. So that's where I put high yield. I think that we have finished all the questions. Okay. So if anyone has questions or wants some of the articles I referenced, let me know. I put 3 articles in the resources. Once again, that link will pop up. And if you want, you can fill out that webinar survey that comes out at the end. My colleagues like to laugh if anyone says anything mean about me. So feel free to throw in whatever you would like. Anyway, thank you guys very much. I hope you have a great night. I'll start another series sometime in August. We'll see what that poll results were to try to pick a topic. Thank you.
This video has been prepared for clients of Morningstar Australasia Proprietary Limited and or New Zealand wholesale clients of Morningstar Research Limited. Any general advice has been provided without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.